What is going on, everybody? Welcome back to the channel all about real estate. My name is Lewis, and in today's video, we're going to do a 10-year look back on the real estate market. We have some really interesting stats and facts from the National Association of Realtors, and we're going to share that with you here today. In addition to that, we are going to do a 10-year look back on the Sacramento market as well, so please stay tuned for that. Now, if you are new to the channel and you like all things finance, real estate, and investing, consider liking and subscribing to see more weekly content just like this. Let's begin. All right, so I'm going to go ahead and share my screen here. I have an article up from the National Association of Realtors. I'll go ahead and link to it in the show notes below so that you can check it out yourself. But it is titled the 10-Year Challenge Homebuyer Edition. Like I said, it's got some really interesting stats and facts, so let's just jump right into it. So 10 years ago, the average sales price of a single family home was actually $169,000, whereas last year we were up to $363,000. So this equates to a positive equity gain of $225,000 for homeowners over that time period. So in that 10-year time period, the average price of a house has more than doubled. Let that sink in for a little bit. It's pretty unbelievable. Now, the average 30-year fixed interest rate just last year was 3.1%, while 10 years ago, it was 4.45%. So about 1.5% higher with regards to interest rates 10 years ago. So we have seen the prices of real estate go up while the 30-year fixed interest rate has gone down, which you could obviously make a case for that making housing more affordable. But if you look at the actual price appreciation, the cost of housing has certainly gone up because the appreciation or the price increases has outpaced the reduction in interest rates. Now, the other thing that I want to point out is that 10 years ago, that was arguably the bottom of the market. And to illustrate that, here is a chart from the St. Louis Fed showing the median sales price of homes sold in the United States. And what you can see here is that we saw a peak that most folks are aware of into 2006 and 2007. That was leading up to the great financial crisis. And then from there, we saw the prices of housing come down dramatically. And they continued to fall into, and they continued to fall into 2009, 2010. And they basically hit a bottom sometime between 2009 and 2012. Now, since that point, we have had nothing but price appreciation year over year, as you can see illustrated in this chart. And it shows what could presumably be another peak in 2021. Now let's jump back into the article here and take a look at first-time home buyers. And this is really interesting to me because I think the data is rather telling. So it says that 10 years ago, the home buyer tax credit had actually expired. So the share of first-time home buyers dropped from 50% in 2010 to 37% in 2011. Now, for those of you who are not familiar with that home buyer tax credit, at some point the government had came up with this incentive. I believe it was up to $8,500. And that was an incentive for first-time homebuyers to get into the market. They could basically use that tax credit to offset some of the down payment and the closing costs involved in the transaction. So it was really an effort to stimulate the economy and pump the housing market back up. But of course, like it says in this article, it expired in 2011. So the share of those first-time homebuyers actually dropped. Now, with low inventory, rising prices, high rents, and student debt, in 2021, the share of first-time homebuyers has actually dropped to 34%. In addition to that, the typical age of a first-time homebuyer 10 years ago was actually 31, while now the average age is 33. So this is not necessarily a great trend that we are seeing here. It basically means that first-time homebuyers are having a more difficult time getting involved in the market. They're having to wait till they're a little bit older. They're having to pay down more debt. They're dealing with saving up for some of these down payments and closing costs. And then, of course, the prices of these homes have skyrocketed. Now, the article goes on to say that in 2011, following the Great Recession, many were on the lookout for a job change. Among home buyers, 10% of buyers actually moved due to a job relocation. While today, many are willingly changing careers, but with remote and hybrid work patterns, only 5% of buyers are moving due to a job relocation. So I'm not sure entirely how they get this data, but I certainly believe it. It makes sense because the technology has improved so much, and with everything that we've had to deal with the pandemic, it has sort of pulled that technological demand forward, making it so that more and more folks are capable and willing and able to work from the comfort of their own home, which means that the location of their property is a little bit less important. We've started to see that in some of the migration trends that we have actually discussed in prior videos. Now, I find this really interesting here as well. It says that 77% of buyers purchased detached single-family homes. So the bulk of sales were for just your standard single-family home. That makes sense. However, in 2021, so just last year, that share has actually grown to 82%. And it says that buyers are seeking more square footage for remote work, for homeschooling, larger kitchens, and private yards, which a detached single-family home obviously provides. The majority of buyers are purchasing in suburban areas, which is more likely to have detached single-family homes instead of condos and townhomes. So this is really interesting. I definitely see this trend sort of unfolding here as the months and years have gone by. Basically, it is a flight from the more urban area into suburbia. And people are looking for homes that have more space, they can distance a little bit easier, and it can accommodate the needs or the growing needs of schooling and remote work. And actually, one thing that I have been considering with regards to real estate investing more recently is that many would argue that a starter home would be a 3-bed, 2-bath, and I would really agree. But I think that the demand for 4 bedrooms will actually increase over time if it hasn't done so already, because I believe that people would like to have that extra bedroom to have that home office or a studio or a home gym because of everything that's been going on in the world. Now, I don't know whether or not that trend will continue, but it's something that I'm really interested in if I'm looking to purchase a home and retain it as a rental property. Now, the last thing here in this article that they touch on is the use of the internet or technology with regards to selling houses. So it says that the home search process for most buyers starts online. Not surprised by this at all. I think most of us, when we're looking to get information on anything, we start online at this point. But it says that 10 years ago, 88% of buyers used the internet in their search process, while last year, 95% of buyers started their search here on the internet. So in just one decade, buyers have increased online tools they use, adding in virtual and video tours, interactive floor plans, and interactive maps of neighborhoods. I know that I personally do this every single time I look up a property that I am interested in. I pull up Google Maps, I check out the street view, I try to see if they have an interactive floor plan or a virtual tour, and basically I do as much due diligence as I can and gain as much data as I can before I actually go look at that property. So that is going to wrap it up for the article on the National Association of Realtors doing the 10-year look back. Really no major surprises there, but that data is very interesting. We know that prices have gone up, we know that rates have gone down, we know that first-time home buyers are definitely having a harder time getting involved, and of course we know that more and more people are starting their search on the internet and using more and more technology with their home purchase. Now, with all of that said, I want to dig into the Sacramento market. Let's take a look at the stats and facts and numbers that I found there. All right, digging into the Sacramento market, I have up on the screen some nice charts from Trend Graphics, and the Sacramento region I am breaking down into Sacramento, Placer, and El Dorado County. We are doing a 10-year look back. So we're going to go back to 2011 all the way up to 2021. We're going to take a look at everything here and see what we have going on. So up on the screen is the first chart. It's for sale, sold, and pended. So the light green bar is the number of homes for sale, the dark green bar is the number of homes sold, and the red line represents the number of homes under contract to be sold. So a couple interesting things that I want to point out here. So back in 2011, look at the number of homes listed for sale. It was dramatically higher than where it is today. So at the last quarter of 2011, we saw about 5,500 houses actually listed for sale on the market. And of course, it looks like that trend goes down, but if you kind of just drew a line here all the way across and we took an average, we're probably somewhere between 3,500 and 4,000 units on average for sale at any given time. Fast forward to last year, look at the number of homes listed for sale. So those light green bars. Just last year, we had at one point only 1,000 units for sale. In 2020, there were a couple times where we only had about 1,000 units for sale. Dramatically lower amount of inventory. One thing that I did notice that's kind of interesting here on this chart is that if you were to take a line between the number of homes put under contract and the number of homes sold, and you just drew a straight line, there are some peaks and valleys there, but overall it is really, really steady in any market condition. So it's really interesting to pay attention to. There's about 2,000 units, I would say, on average, if you just took that line, drew it right across the middle, that are either being put under contract and being sold. And that looks like it's held relatively steady over this last decade. So really interesting. Now, if we jump over to the price per square foot, this is one of my favorite metrics to help measure value. But what's interesting here is if you go back to 2011, we were under $120 a square foot on average. That to me seems insanely low. I don't even know if you can build for $120 a square foot even 10 years ago. I mean, certainly you cannot today with the rising cost of materials and labor. I would say if I just had to place a guess on this, I would say that it's probably going to cost somewhere around $250 a square foot minimum to build today. That might not even include the land at this point. I might need to jump online and see if I can get that data somewhere. That would be interesting to find out. But anyway, look at the trend here. So price per square foot on average has basically just risen. If you go back last year, we're up over $320 a square foot. So average price per square foot now is probably right around $323, $325 per square foot. So that has certainly more than doubled in the Sacramento region here over the last decade. Next chart, we have the average days on market. So this one's pretty interesting here to me. The green line represents the sales price versus the original list price. That, I mean, honestly, there's some times where you sell above list and some times where you sell below, but overall that is relatively steady. What is really interesting here to me is the average days on market. So if we do a 10-year look back, the average home was taking almost 3 months to sell, which is pretty crazy when you think about where we are in today's market. Now, I think even prior to 2011, that the average days on market might have been higher than this because we were in kind of the thick of that great financial crisis and home prices were still kind of falling and bottoming, and inventory levels may have been a little bit higher as well. But you can see here that the trend went down into 2013, and then we started seeing homes sell in less than 30 days, and then they kind of pumped back up again to where they took maybe 2 months or so to sell. If you were to just kind of draw a line and see if you could find the average, we're probably averaging maybe 40 to 45 days on market in general. But now if you go towards last year and you take a look at the average days on market, I mean, dramatically lower. We were on average basically 3 weeks on the market, 20 days. And that lasted for the majority of 2020 and nearly all of 2021. Okay, now the fun stuff. Let's take a look at the average sales price. So you have the green line, which is listed for sale, and then you have the red line, which represents the average sale price. So you go back 10 years, and the average sales price in the Sacramento region was roughly $220,000. Well, now you fast forward to today or last year, and the average sales price is actually just over $600,000. So, wow. Let that sink in for a little bit. That is unbelievable to me. So prices have nearly tripled in the Sacramento region. So it is a really, really hot housing market, as most of us already know, but that is pretty interesting. It makes me think to myself that I wish I could go back to 2011, and I wish I had the means to go out and buy 10 of these properties because they did so well over the last decade. And then the last chart that I want to take a look at with you is the month's worth of inventory. So if we're taking a look at the month's worth of inventory, currently we have less than about a half a month of inventory. and that is as of the end of 2021. Whereas if you go back 10 years, we had about 2.5 months of inventory, and there were some peaks and valleys there. But if you drew a line, the average was probably right around 2 months worth of inventory. Now, what that means is that if no other homes were to hit the market, it would take 2 months to sell everything that is on the market. Generally speaking, anything less than 3 months is considered a seller's market. 3 to 6 months is neutral, and 6 months or above is a buyer's market. So you can see that we were basically in a seller's market from 2011 all the way up until last year. Now, if I would imagine, I don't have the data, but I would imagine if we went back prior to 2011 and we saw the inventory numbers from, let's say, 2009 and 10, I would imagine the inventory levels were much, much higher at that point, given the climate with everything going on in the great financial crisis. All right, so that is going to wrap it up for today's video. What did you think about the 10-year look back? Do you think that real estate was cheap back in 2011? If so, do you think that it is expensive today? What are your thoughts on the market? Do you think we're in a bubble? Do you think the market will crash? I didn't make the video to do any sort of fear mongering. I just wanted some of the stats and facts on this market and what we have done over the last 10 years. I find it really interesting to zoom out and do more of a macro view and get an idea on where these numbers are going so that we can make educated and informed decisions moving into the future. Anyway, thank you so much for taking the time to watch this video. If you haven't done so already, consider liking and subscribing to see more weekly videos just like this. Thanks again.